That, I think, is going to be the key to success of building one's business.
I would just comment that the key to success from my perspective in this business has always been judgment and imparting good judgment. And to me, there's no bigger issue than how to put 2008's performance in the perspective of a longer-term track record. And I think what people are going to find is that more and more eliminating 2008 because it was so sensational on the downside is probably not a bad idea in terms of how you go about analyzing managers.
Larry, Phil, thank you so much. I think that this has been an amazing way to set the tone for today, and I hope that everyone enjoys the rest of the conference. Thank you so much.
Thank you.
Oh, we can? Okay.
Well, we have one time for one question. Is there a question?
A really, really good question. Okay. And we're going to bring a microphone over, so just hold that question for 1 second.
I guess I have to stand up.
Do you mind introducing yourself as well,
yeah,
please?
My name is David Lloyd. I'm with Carlson Capital. My question is for Mr. Duff. Do you get to the level of granularity with your LPs such that you look at their liability streams and you try to create basically bespoke portfolios that match those?
Yeah, I think the objective is, I mean, think about, most CIOs that run pension plans, they're investment people. They're not necessarily, actuaries. And, the three main risks on the liability side of a pension plan are interest rates, inflation, and mortality. And often, a CIO will take the output from an actuary and kind of treat that as, that's a fixed, known, given number that I got to solve to. But the reality is, even though you don't see it, ticking on your screen, there is arguably as much variability and risk and volatility on the liability side of these pension plans as there is on the asset side. I mean, for example, if there was most actuaries, their tables take into account that life expectancy is getting older at an increasingly rapid rate, but what they don't take into account is that risk of if, for example, if there is a broad cure for a broad spectrum of cancers, in a very relatively short number of years, you'd have a fairly significant increase in life expectancy. That'd be a great thing for mankind, but it's a horror story for someone with long tail liabilities based upon longevity. And so, as we say, you not only have to know what you own, you also have to know what you owe. You got to manage your assets very much in concert of what are those assets funding.
Great. We're good? All right. Thank you very much, everybody.